It's time for the moment of truth, the moment you've all been waiting for. It's the Stock Market Brief Show. My name is Michael Silva. Hope you are having a wonderful day. If you're new here, we use technical analysis, intra-market analysis to get a good idea as to where the market might be headed next. If you come here often, make sure to leave a comment or smash that thumbs up button. It is greatly appreciated. We're going to be getting right into it today, all right? The moment of truth has come. Now, I posted this, but I didn't add any chart. This was on Twitter. If you don't follow me there, you can follow me there. And it's all, everything that we're going to talk about is really to prepare you for what's just right around the corner, okay? It's to really show you just how much risk that we're about to be stepping into. It's absolutely crazy. But I posted this here because, I don't really think many people look at this or measure or map this kind of rate of change between these two assets. But since mid-June, the rate of change between growth and value, which I'll show you, has spiked into positive territory. Bullish, right? However, the performance in rate of change terms has been decelerating, okay, since mid-June, since the peak. Now it went from 3.8% to 1.65%, but that was on July 21st. I'm going to show you what it is now. And that's as the RS line is moving higher. So the relative strength line is moving higher, but the rate at which it's moving, that these assets are going up against each other, is decelerating. So this is the divergence it's building, and I was watching to see it if it crosses down through zero. Why? Well, let's walk into that and why it's important. Why am I looking at growth to value? Well, growth, right, it's a huge weight on many different indices, right? Growth stocks are huge. And how I'm measuring mapping this, I'm looking at IWF, which is Russell 1000 growth. You can use another growth fund if you'd like. And you divide that into the value fund, okay? Which I'm using IWD. And you can use a different one and then measure map it. It's going to look very similar. I put a 10-period rate of change down beneath the screen. Now you might be like, okay, well, I don't get it. Like what happens when it crosses down through zero? Well, I'll show you, okay? Jeez, calm down. Swear. All right, so this is what this is what it looks like. First and foremost, price action. You can definitely use technical analysis on this type of stuff. It is wedging. You can see it's putting in higher lows, higher highs. It's getting very, very tight, and it's coming into a prior area that was once support, and then chopped up here, broke down. Now it's going to test it to see if it's going to hold as resistance. Now, as the price action of this RS line was moving higher in rate of change terms, you can see it's actually not putting in higher highs and higher lows. It is putting in lower highs. Okay, so you might be thinking, okay, what does that mean? Does that mean just the RS line goes down? Well, I want to pull up this chart right here. Now, this is interesting because as you see, this is measuring and mapping IWF over IWD, but that chart is actually invisible. What you see right here is the Qs. Okay, that is the Qs, but what you see down here is the same rate of change that we measured and mapped on the previous slide. And as you can see here, I highlighted every time it crossed down, up and down through zero, right here. Those are the red lines on the screen. And what you can see is, guess what? The Qs saw some weakness. Boom, boom, boom. Boom, boom, bang, bang, boom, okay? So does it mean that the Qs are going to be taking some big hit to the downside? That's not what this means, but it is giving us insight that, hey, if it does cross down through zero, the rate of change between growth and value, it could indicate that we might be in a period of digestion or a pullback, or consolidation, okay, in the Qs, which is a huge weight. Now, on top of all of this, all right, we got so many more charts to talk about. It's crazy. This is, you can screenshot this if you want. This is the S&P 100 components that have earnings next week, okay? The ones in dark gray are reporting next week. I'm sure you know this, right? Apple, Amazon, Meta, Google, Microsoft. 5 big monsters, right? They are reporting earnings. So this is something to be very aware of. We will be looking into their expected moves, but not today, unfortunately, because it'd be taking up too much time. I put that out on my Patreon group. If you want to see those and you're part of the Patreon group, you can see those expected moves there. But this is important stuff because we're talking a huge week, pivotal week coming into next week, right? And for earnings. Now, what we are looking at here is a couple of different things. So we're looking at the biggest losers and the biggest gainers as far as earnings so far. And the ones that are highlighted a little bit bolder are the the bigger names. So Citigroup, State Street, Wells Fargo, Goldman Sachs, Netflix, Morgan Stanley, Tesla, Nokia, U.S. Bancorp, BlackRock, and so forth, okay? And you can see these ones all, maybe some missed, but they still ended up green. A lot of the financials were the ones that were ending up in green, but I also want to point focus to here. So Snapchat, which is a huge name, we already know that got hit down significantly. We have AT&T that took a brutal hit, even though that it beat earnings, right? So it still fell 10%. American Airlines is down 10% since the move since earnings. Seagate Technology, right, down 8.1%. Mattel down 7.4%, and that still beat. It's how the market interprets all this stuff. So I want to really preface this, because what I find so interesting about this right here, a lot of the financials that have been ripping, and I'm currently short the financials, I built out a position, is that we have still an inverted yield curve. Now it's going on more than 10 days, around 10 days of the 10 and 2 being inverted. It was previously inverted like here in April, but that was like one day, came out for a month. Now it's been hanging out here. And then not to mention, we have the 10-year and 3-month that is continuing to fall off a cliff. Okay, I haven't even mentioned yet that the Fed is next week. All right, so the 10 and 3-month is heading towards inversion. I would not be surprised to see this inverted next week. That's what it looks like. And this is not good for financials. This is not good for the economy. This is just not good. All of this is just not good what's taking place. It's crazy. Just take a look just how powerful of a move Snapchat was down. Huge hit to the downside. This is, we've been getting big hits to the downside. So do not overlook this, because this could affect, not to say that it's going to happen to Meta or Facebook, but you just got this is just warning shots saying, hey, careful coming into next week. And we got more charts to go over, but even look at Verizon, right? Verizon, we don't see these type of moves in stocks like this. Those are huge moves, and they should be paid very close attention to. But it wasn't even Verizon. AT&T, look at that move. These are just ridiculously sized moves in a very short period of time, and they're saying things like, their more delinquency rate is shooting up with customers paying their cell phone bills, which is just not a good sign, right? That is something that people that's a huge necessity to a lot of people. So the fact to see 30, 60, 90-day delinquencies, and by the way, I used to work in the communication industry, and I used to measure and track that stuff, and I'd always bring it to management and talk to them. It was Verizon that I worked with. And I'd say, hey, why are these delinquency rates going up? Oh, blah, blah, blah. We make financial plans, da, 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 da. And then you kind of just brush it off. But it's going to be a problem at some point, especially if delinquency rates continue to move. I'm getting off track there, but let's look at also, not only do we have earnings next week, right? We have a big week ahead of just economic data drops. These are 3-star, right? From the rates from 1 to 3 stars trading economics as far as the impact that they have on markets. This is for major countries. So we got all kinds of stuff going on, but I'm not going to dig too much into this one. Just screenshot it if you want to look at it. I'll go into this one right here. This is America. These are 2 and 3 stars, what's reporting in. We have new home sales coming out, right? We have durable goods. We have the Fed interest rate decision, the Fed press conference. We got the GDP numbers coming out, right? And Atlanta Fed GDP is, forecasting like minus 1.6% or something like that. We have personal income. We have personal spending. These things are going to be increasingly more important, and you're going to see them hit the tape. So be aware at these times when they come, because when you are in the market, or if you're day trading, or whatever the case is, and all of a sudden you just get one of these news drops, the market has been so volatile. You can see literally just the moment that these news drops hit, huge moves in the market, like very quick hits, okay? Now, we're all wondering, okay, what's the Fed going to do? Well, you don't really need to think too hard and far about that, right? The Fed Watch tool is basically saying, hey, there's about an 80% chance that they're going to be raising 75 bips, right? The ECB raised 50 basis points, and that was somewhat of a surprise, right? They thought they were going to move up 0.25. They went up 0.5, 50 basis points, sorry. And over here, you still see there's about a 20% probability that they do a 100% rate hike. So we'll see what the Fed does. coming up here momentarily, right, into next week. Now, with all that said, okay, we have all kinds of economic news coming out. We have huge earnings, and now I want to layer on some technicals to all of this stuff, okay? We got, macro stuff, earnings. We see earnings deceleration, earnings recession probably up ahead, all right? We probably walking into a recession. We might be in a recession. We have all these economic data drops, and now to layer it on, I want to show even more stuff taking place from a technical perspective. Yeesh, I swear, man. So much stuff, and I'm going on vacation, so I don't even get to watch these fireworks take off for the most part. BP COMPQ. What is that, Mike? This is the NASDAQ bullish percent index. Okay, I like to look at the RSI because it has been a good help being hand when things get overextended to the upside or the downside. It has not been above 70 since right here in earlier June. What happened in earlier June? Oh yeah, we had a bear market rally and then we tanked and created a new low. Well, we're there again. Well, what happened prior to that? Well, yeah, that was that was the March bear rally, and then all of a sudden price started, jerking around before it just took a complete drop there too. Okay, so it's been helpful, and it's also been helpful to mark some types of bottoms because you can look at both sides of this story, right? Okay, so that's BPCOMPQ. Walk with me faster here. BPNDX, 69.73, almost in the 70 territory. Okay, so yeah, overextended can stay overextended for a while. We've seen that prior, so the market can still push up and get more overextended. But yeah, we're already getting there, all right? So BPSPX, up 69.46. Yep, moving into overextended territory. Up, oh yeah, Dow Jones bullish percent index, 69.80, moving into overextended territory. Oh, some of the big dogs, the big sectors, consumer discretionary, it's at 70.86. It is in overextended territory. The technology sector, 70.75, a big one, and even bigger to state that we have big tech earnings coming into next week while we're already overextended to the upside. So can this push further up? I'm kind of hoping that it might, because it'll probably create even better opportunities to short into or fade or sell into that rally, all right? Now, a couple other things that I want to point out. The Pring Bottom Fisher, it's taken a little turn here. Now, don't put too much weight on it, right? A lot of people that follow me know that. But you can see when it turned over here, we fell. When we turned over here, we went up, and then we fell. Ooh. When we turned over here, we fell, and when we turned over here, we fell. So yeah, 3 out of 4 times we basically, started turning down. So I don't know, right? 3 out of 4, it's a pretty good odds. It hasn't fully turned over, but it's starting to curl. Can that change? Yep, that can change, right? Especially if we get great earnings or whatever, the market interprets it as good, and we start shooting up. But as it stands right now, pay attention to that curl. Okay, continue on. I want to look at some larger time frame charts. Stay with me here. It all ties in. Stay with me. We are looking at the S&P 500 on the monthly time frame. The red shaded area is bear market territory. Guess what? We're not in bear market territory anymore, but we are still below a declining monthly 5 EMA. It is one of the most frequently tagged. If you didn't watch my monthly recap show where I brought this chart up when we closed down here, I said this is the most frequently tagged EMA. So could you be shocked to see it come all the way back up to tag the monthly 5 EMA? That is exactly, precisely what is taking place right now, and we're still within the monthly expected move. I have a couple dashed lines on the screen, right? The dashed line is the quarterly expected move. Pretty big. The straight line that doesn't have any dashes is the monthly expected move, and we're not too far off of that, and that also lines up to around the 5 EMA too as well, which is at 4,071. Okay, so that's also it's in the cards still. Okay. Let's continue on at the Qs. Qs on the monthly time frame. We are in bear market territory. We are still below a monthly 5 EMA. We tried to get up there and touch it. We came close, right? The high was at 308.55, and the EMA is at 311. So a couple bucks away. But you can see here, we are still within the monthly expected move. We came outside of it. Today, we came right back inside of it. The IWM just about tagged the monthly 5 EMA. You can see here we are still in bear market territory. Even the quarterly upper expected move is still in bear market territory at this particular point in time. So this is just it is a trend that is down in the IWM, in the Qs, and on the S&P 500. And you can look at the PPO. The wind is still in the face right now. Okay, nothing amazing has taken place. The longer term trend right now at this particular point in time is down. It would be nice to see a monthly close above these levels, but even the monthly expected move for the IWM was tagged, and we're starting to see it come off a little bit here. We still got time in the month, so we'll pay attention. We'll see what happens, but just be aware of this trend. The trend is important to note. The trend is your friend until the end, and the trend is down. Let's look at the SPY. Expected move for next week. Okay. Oh, by the way, I don't have it with me right here, but the SPY, it came outside of the expected move, and guess what? Today, it came right back down to it, and then we bounced slightly above it. So in the S&P 500, finished pretty much a few bucks outside of the weekly expected move, which to me, that to me is pretty spot on to the 68% of the time it finishes within the week. Even though it got outside of it, we talked about it on the prior episode, and we came clearly the market came down today slightly. Doesn't mean that this is. One of the biggest things that we mentioned yesterday at the end of the video was, or the prior day was, the next big important thing to watch is how the market digests this move to the upside. It's either going to be a pullback or consolidation. If it's a consolidation, something like this, that's actually more bullish than anything. That's a bullish consolidation. Then if it breaks down, bearish. If it breaks up, bullish. Okay, so the upside 405, downside 385 roughly, okay? And I call that, I have a couple little red lines on the screen, these steps that are stepping down. Even if the price were to come up to 415 and people were to, woo, told you it's over, yeah, we're done, it's still lower highs, okay? So nothing actually really changes even if we were to get up to there. Let's look at the 15-minute time frame really quick. 15-minute time frame. So from a shorter perspective, we are still above a 5-day inclining now moving average. So technically, short term, we're more bullish focused right now. If this starts breaking down through these levels, that's going to change. If this starts curling back over and price action gets below it, that's also going to change. Okay, so that's what we'll pay attention to. I'll follow up a little bit more on that on Monday. The Qs, you can see here, very same situation. On the March bear market rally, we came up and tested that prior peak of that bear market. We ripped up, and we haven't quite reached this bear market rally, reaching this peak right over here. So it's a possibility that we come up there. Where is that? Well, that is the upper weekly expected move, just above 310 and just above 290 on the low end there. So if it comes back down here, guess what? That lines up with a couple areas of previous chop. It's more than possible, especially given that we have these huge earnings in the next week, all right? Anything and everything is currently possible, but as it stands right now, I hope you're getting the idea of why it's very dangerous to be long right now, okay? Let's continue on. If you take a look at the Qs on the 15-minute time frame, we are technically above that 5-day inclining moving average. Okay, we bounced pretty much right on it today, and as the RSI got a little overextended to the downside. So currently, in the short term, it's bullish until that changes. The IWM, we're looking at about 185 to the upside, 175 to the downside, and you can see here we can potentially get outside of it, even 190. Even if we get up to that level, we're still below those 200-day moving averages, and it's coming back into prior areas of once support, then became resistance, so that would be a level of focus if we start cracking further to the upside. If you look at the 15-minute time frame, we did pull back into this, which, by the way, came into the weekly expected move, even though it got way outside of it. Bounced on the 5-day moving average, and you can see kind of doodled around in here. It actually came down, did a U-turn, pulled back, tested as support, and we started rocking it up. So if this low is starting to take it out and we close below the 5-day moving average, that could be pretty bad. It could set up for a move down to fill this gap and potentially hit the lower weekly expected move. Let's continue on to the dollar. The dollar is still remaining to be in a bullish trend, okay? The dollar has had a negative correlation to quite a bit of assets, big assets like the S&P 500, like oil, like gold. So if the dollar wants to fire off right now, it could very well still bring down this asset. Now, a lot of people are saying, hey, this trade, it's over, it's done with, because, everyone's bullish to the dollar now, so start looking elsewhere. If that is actually the case and the dollar starts pulling up, where are people going to turn to? Where are they going to turn to for safety? And that is potentially when they might step into bonds. So you can take a look at TLT, you can take a look at BAB. There's a bunch of different, like EDV, I think, or something like that is kind of like TLT. The expected move as it stands right now, 116 to the bottom side, about 122 to the upside there for the week. I'd be watching for a hit to the downside, and I might be actually looking to accumulate right around there to potentially down to around 112, because that is actually one of the risk zones that I pay attention to, which it's currently loaded there, and my Patreon members know that because I posted that on the Daily Zone report. Now, UUP, I'm going to pull that up really quick, the weekly expected move. There is some pretty big downside down to 28, and that would come to prior resistance, and then we broke above that, so it could potentially act as a level of support, okay? So dollar down this way. I think gold is an opportunity if the dollar wants to pull off, because remember, if the trade is actually done with, you got to say, okay, where are people going to go for safety? My thought is you got TLT bonds, okay? That could be a possibility. It might be too early. It might not be. So we're going to pay close attention to that in these next couple of weeks, okay? But then you also have gold. If the dollar starts backing off with that strong negative correlation, that can actually be an opportunity now. And it's been a lackluster heck of an opportunity for quite some time. It's been breaking key levels. It finally found a little support. So you got to still be careful there with the shiny rock that apparently nobody wants except for me. At least just not right now. All right, now, a couple other things. Last thing mainly here is the zones. You can screenshot this. I'm not going to walk you through what these are. I share this with my Patreon group too as well. But I have a little drawing here, okay? My little drawing. This right here is a demonstration of these risk zones, okay, or the zone. So S&P 500 current low portion of that zone, which helps depict risk, is at 3768, and then the high end is at 4024, okay? And we close at 3691. So this is telling me that the upside right here is about 1.58%, but it's versus about 4.86% downside. So there's still more downside risk. Now, if you've been watching my show for the last couple of episodes, this was actually a higher number. So you're starting to see some of the downside all of a sudden reduce itself, while the upside you're starting to see the upside reduce itself and the downside decrease to make smaller moves. So that is something to pay attention to right there. And the reason for that right now is because we just saw the market actually have a down day, which skews these numbers. Now, the reason why I'm showing this drawing here, this is important to note. The S&P 500, this is the SPX, okay? The last 4 trading days, what I'm pointing out here is it has hit the top end, the high end of the zone, the high end of the zone, and the high end of the zone. Now, typically, when this happens, especially in a bearish trend, this is where you can start applying a little bit more positions. Instead of buying down here, shorting down here, like many people do, you'd have a better opportunity to short at the higher end. And you can see on today, where we finish more towards the low end, you can see here, this is actually, these lines, this is actually me just tracking where the range was, okay? So it moved up higher, higher, higher. Today, it actually sloped itself slightly down a little bit. So it's going to be interesting to see if this starts flattening out to heading down. But meanwhile, during the time that the upper risk was moving up higher, as price was squeezing higher, the lower range actually moved lower, okay? It was not moving up higher, which would tell me that, hey, we could be moving into an uptrend right now, but it is not. It has been down, and it continues to be down. So we'll see here if that changes, but as it stands right now, you can see, if we're right here, that is the possible upside. This is the possible for the downside. So this is just kind of giving us a good idea of potential risk, potential reward moving forward. Okay, so that I'm just trying to explain a little bit better, not only for everybody that's watching that's not part of Patreon, but people that are obviously in the Patreon, because I share my notes, but I never get to talk about it. Which, by the way, I never bring it up, or I hardly do. I want to thank both my Patreons for being part of the swing trader community, or the Discord community, actively engaging in there. I try to constantly add more and more, and I do it for dirt cheap. Not gonna lie, $9 a month is absolutely nothing for the amount of data and work that goes into it. And if you pay on an annual basis, it's like $90, and you say it's 16% off basically. So it's like ends up being $7 a month. So yeah, it's dirt cheap, especially compared to other services out there. And then on top of that, Interactive Brokers supports my channel greatly, and I never talk about them because, even if you were to sign up with them or click the link below, it doesn't make me more money by you signing up. They support my show just by just click the link and going over into their thing and just taking a look at what they have. They have an absolutely incredible broker firm. They have great software, and then they also have a great academy, which I never really talk about, but they have a cool podcast. They have all kinds of learning materials and stuff like that. You can visit their campus, but they're also an award-winning broker. Okay, so yeah, big thanks to Interactive Brokers. Big thanks to the Patreons for constantly supporting me. It is obviously what was allowed me to leave my six-figure job in the corporate world. Went on a tangent over there. Hope you all have an amazing